Late nights, early mornings, he stays on the grind. Looking past the rate sheet for the value you'll find. He listens, he hustles, he speaks with intent. Every signature means more than the dot.
Hey, good morning and welcome to What's Up with Real Estate. I'm Mortgage Mack. And hey, this is a live show, which means anything can happen. Markets move, headlines break. Technology occasionally throws us tantrum, and so does ChatGPT. So, well, we'll just call it all unplanned spontaneity. And here's what we're watching today. Inflation is heating up. Fed held rates steady. Mortgage rates. Oh my goodness, you have to stay tuned to what we're going to talk about with regards to mortgage rates. A long yoga stretch upward, and housing activity still trying to find some footing. All this and more news you can use for weekending March 20th, 2026. I'm your host, Mortgage Mack. That's first name Mortgage, last name Mack. And you know what? We know that we build relationships with buyers and real estate agents to help everyone win, along with our favorite co-host, your favorite co-host, my favorite co-host, everyone's favorite co-host. So say hi.
Hey everyone, I'm thrilled to be here, ready to dive in with Mortgage Mack. We'll break down the numbers, give you insights, and maybe have a little fun along the way. Let's get started.
So, talking point number one, the Fed is, well, standing still, and that might be a problem. So, at the March 18th FOMC meeting, which is Federal Open Market Committee, the group that sets interest rates, the Feds held the federal funds rate steady at 3.5 to 3.75%. Now, here's the issue. Inflation measured by personal consumption expenditures ticked up. I believe the PPI also kicked up. We'll let Sol enlighten us on that as well. That's like trying to, if you take that into consideration while job growth is slowing, well, it's kind of trying to hit the gas and the brakes at the same time. And now we've also got a geopolitical issue pushing oil higher, which means more inflation. So define PCE and Fed funds rates for us, please.
Of course, PCE, or personal consumption expenditures, is basically the Fed's favorite measure of inflation. It tracks how much consumers are spending. The Fed funds rate is the interest rate banks charge each other overnight. Think of it as the baseline rate that influences borrowing costs.
Was there PPI data released yesterday as well, or this week? Doesn't that normally get released at the same time as the CPI?
You're spot on. The PPI, which measures wholesale inflation, think producer costs before they reach consumers, usually comes out close to CPI, the Consumer Inflation Report. This week, PPI did show an uptick, adding fuel to inflation concerns. So both PCE and PPI nudging upward means the Fed's balancing act just got a bit trickier.
Yeah. In Houston, this matters more than many other markets because we're so energy sensitive. Rising oil can boost jobs locally, but it keeps inflation sticky, which delays rate cuts. So are we looking at a Fed that's stuck here for a while? I believe we are.
I'd say it's likely, yes. The Fed won't be eager to cut rates if inflation stays persistent, especially with energy costs in play. So we could see the Fed holding steady longer than many had hoped.
What does that look like if the economy is shrinking, the Fed interest rates are rising, and the Fed's hands are tied? I mean, it seems like classic Fed gridlock. Give us some perspective on what that might look like. I know we've been talking about stagflation as a real issue since tariff liberation day last year. We've always believed that the introduction of tariffs was inflationary at best. Now we're entering into a global we are in a global conflict and have been in global conflict for quite some time in the area of proxy wars in Ukraine and even in Gaza. Now we're in Iran. And there is talk now in the dominant media as it relates to stagflation. Kind of give us a perspective on what that might look like for everyday homebuyers, please.
Stagflation is that tricky mix of slow growth, rising prices, and higher unemployment. For homebuyers, it means affordability gets hit from both ends. Their wages may not keep up with inflation and borrowing costs stay high. It's why being prepared, knowing your budget, locking in rates at the right time, and exploring any buyer incentives becomes critical. You don't control the macro, but you can control your readiness.
That's right. That's right. Preparation is truly, truly the key. And moving on to our mortgage rate update for the week. And well, mortgage rates went up rather dramatically on Friday. And if you thought mortgage rates were settling in, well, let's think again. According to Mortgage News Daily, mortgage rates have now moved back above 6.5 after being on a low of 5.99 at the end of February. And, that's a pretty aggressive move in such a really, really short period of time. And it's the highest level we've seen since September of last year. So what's driving it, Sol?
The key driver is shifting expectations. The Iran conflict has spiked fuel costs, feeding inflation worries. As a result, central banks, not just the Fed, are turning more hawkish, meaning they're signaling tighter policy. Mortgage rates react quickly to these signals, so as markets brace for more inflation, rates move up. In short, it's not the Fed's actions, it's what markets think they'll do next.
Yeah, it's the administration's actions with war and, you know, and the closing of the Strait of Hormuz. This is totally unnecessary and unwarranted from my perspective, and it clearly is having a negative impact on the economy. In Houston, however, oil prices can actually strengthen parts of our economy, but at the same time, keeps mortgage rates elevated. So we get this strange split between stronger local economy, but challenged affordability. So if the Fed hasn't actually raised rates, then give us some perspective for folks that don't know why rates are moving upwards.
Even if the Fed hasn't pulled the trigger, the bond market moves on expectations. When investors believe inflation will persist or central banks will tighten policy, they demand higher yields. Mortgage rates track those yields closely. So rates rise not based on what the Fed does today, but on what markets think the Fed will do tomorrow.
Yeah, that's right. That's right. Mortgage rates right now are kind of like gas prices. If you blink, well, they've already changed. And so, coming up next, we'll talk about pending home sales right after this message from our best mortgage company on the planet, Rate.
Looking to purchase a new home? The Rate app from Guaranteed Rate has got you covered. Once you've downloaded the Rate app, click to log in and create your password. This will take you to the intro page. Click the gray Same Day or Home Loans tile, and then click the red Apply Now button. Then click Start a New Loan. Begin by telling us where you are in the home buying process. Typically, for a pre-approval, you will click What Can I Afford? From there, the Rate app will load a series of simple questions. Answer each one the best you can as you move along. Once you've completed the application, your loan officer will receive a notification so they can review your information and set up your personalized checklist. The Rate app even allows you to upload documents right from your phone. It's just that easy. And if you do get stuck or have any questions, just give us a call. We'll be sure to get your questions answered so we can get you one step closer to owning the home of your dreams. The Rate app from Guaranteed Rate, simplifying life's biggest purchase.
Hey, whether you're buying or refinancing or just exploring rate options, then the Rate mobile app gives you real-time numbers, payment estimates, and direct access to strategy to help you and your buyers and your agents win. Go to www.mortgagemack.com, click on the QR code and download your free copy. And hey, if you're out there and you're a mortgage loan originator, licensed mortgage loan originator, interested in joining the team, Mortgage Mack team, please send us a direct message and we'd be loved to visit with you. Moving on to talking point number 3. Well, there's some good news, I guess. Pending home sales index rose 1.8% month over month to 72.1. But hang on. Let's keep this into perspective here. 100% represents normal activity, and we're sitting at 72. So that's roughly 28% below historical norms. So yes, improvement, but we're still very, very low in the activity market. Houston, we're seeing pockets of strength, especially in well-priced homes under 400K, but overall volume is still well below the 2020 levels. So is this the start of a recovery? I don't think so, but I'd love to get your thoughts on this.
I'd say it's more a flicker than a full-on recovery. A slight uptick is positive, but we're still well below normal activity. So it's more like the market is stretching, but not running yet. The key is watching whether this momentum builds, or if it's just a blip. Either way, informed buyers stay ready.
Objectively, what do we need to see from the administration to see normal levels again?
Objectively, we'd need to see inflation cooling consistently, which could ease rate pressures. Stability in global conflicts would help too, as it would reduce energy shocks. And on the policy side, anything that promotes sustainable growth, like targeted housing initiatives, could bring us closer to normal levels.
So basically, the housing market is improving ever so politely. And if you're currently looking to buy, sell, or waiting, please drop us a note in the chat. And moving on to this week's mortgage tip. And is the market shifting to buyer's market? Well, here's how you know the market is quietly shifting in your favor. And let's simplify it. When you start seeing inventory rising, which we've seen, more seller concessions, which I've seen, sales slowing, and prices softening, that's what we call a buyer's market. And seller concessions is when the seller helps pay closing costs. We are seeing that. Buyer's market when supply exceeds demand, giving you, buyer, and your agents leverage. And here's the part that most people miss. These shifts don't just happen with a flashing sign that says great time to buy. They show up quietly and reward the people who are ready and prepared. In markets like Houston, Sugarland, and the Woodlands, we're seeing pockets of this right now, especially in certain price ranges where sellers are getting more flexible. And then here's what happens. Negotiating power shifts, opportunities open up for buyers, and when the buyers are prepared, they win. So in a market like this, what's the biggest mistake buyers are making right now?
The biggest mistake is waiting for the perfect headline. Many buyers sit on the sidelines thinking a big sign will tell them when to act. In reality, the best deals happen when you're prepared ahead of time. If you're ready with financing and know your market, you can move confidently when that quiet opportunity pops up.
Yeah. The best deals don't sit around and wait for people to think about it. It's all about being ready when the moment is right. And if you're even a little curious, this is for you. So send me a message and let's take a look at your options together, because in real estate, hesitation can be expensive, and Zillow doesn't negotiate for you. And if this gave you a little clarity and maybe even a little confidence, do me a favor, subscribe, hit that bell, and follow us for next week's episode and many, many more to come. And when you're ready, let's build a plan and a strategy for you to put you in a position to not just compete, but to go out and win in today's real estate market. Okay, our new segment here is war. We call it the War Report. And according to the most recent statistics, as of Friday afternoon, we had counted 1,728 global deaths. And global conflicts continue to impact the markets, economies, and most importantly, human beings. And we take a moment to acknowledge the cost, not just economically, but personally, the people who've lost their lives due to an unnecessary conflict, which reminds us how much of what we discuss, rates, housing markets, and sits on top of something far more important: peace and stability. Which brings us to this week's Stoic quote. Only the dead have seen the end of war. Is a powerful reminder of something humanity has struggled with throughout history. Conflict isn't an event. It is a condition of the human. It's a human condition that I believe we are in a place today with the advancements that exist for us to finally put war behind us. Clearly, we need different leadership and a different mindset. And what Stoic philosophy teaches us is not to control forces because we can't, but to control how we respond to them. And I do not believe war is an appropriate response unless attacked. And we weren't attacked. And so we're going to move on and have some fun with puns. All right, we've covered inflation, the Fed, the market rates, and even a little philosophy. So naturally, it's time to lower the intellectual bar just a bit to have some fun. Are you ready, soul?
Always ready. After all, we were in to laugh. Let's bring on the puns and end on a high note.
All right, so I don't snore.
I dream I'm a Harley Davidson.
I don't
And
know how
hey,
you got
if
that
that
one.
doesn't
I wouldn't have gotten that one. I had my patience tested and it came back
Negative. I guess that means I need a little more patience. Or maybe
My ceiling isn't the best ceiling, but hey.
it's right up there, just like our show today. High quality all the way.
I came, I saw.
I forgot why I walked in here. But hey, at least we're ending with a smile, right?
All right. So if you're watching and you like our puns or don't like our puns, go to at Mortgage Mack on TikTok and go like our channel at TikTok. And here's one of our videos that we posted on TikTok this week. We thought was amusing to say the least. ChatGPT, stand down.
I'm standing by, always happy to bring the fun and the facts. If you enjoyed today, remember, subscribe, hit that bell, and we'll be here weekly with insights, a little wisdom, and yes, a pun or two.
So
Until
why
next-
did the fish blush?
Why? Because it saw the ocean's bottom? All right, folks, we'll save the rest for next time. Stay tuned, and we'll be here next week with more to share.
That's right. Bad puns, that's how I roll. Hey, thanks for joining us for this week's episode of What's Up with Real Estate. Big thank you to our sponsors, Rate and List Reports, and helping make this possible. If you found value in today's discussion, please subscribe, follow, and share this episode with someone who could benefit from staying informed about the housing market. If you want a plan, not a pitch, call yours truly, Mortgage Mack. And remember, knowledge is the key to making the best decisions for you, your family, and your clients. Join us here every Saturday, 10 a.m., right here on LinkedIn and Facebook. And until next time, stay engaged, stay informed, and I'll see you at closing.
And I'll be here every step of the way.